Hi, this is Gene Trowbridge of the law firm Trowbridge and Nieh. We are syndication lawyers, securities lawyers. Our business is writing the legal documents that will help you and our clients pool investments from multiple investors, and that will take you into the securities world, and you need to do that right so that you don't go to jail, and that's what we do. So I'm going to tell you today about a success story that's kind of unusual, and it isn't really real estate. And quite honestly, most of the money raised in syndication in the country doesn't go to real estate. The SEC said that in the last 12 months, a $2.7 trillion was raised in private placements in the way that we do business, not going to Wall Street. And only about a third of that money was raised in real estate, but most of the money is raised in businesses. Businesses need equity after they borrow as much as they can from the bank and their family and friends and their own money. If they need equity, they put together a group of investors to fund it. And this may sound like a real estate deal, but it wasn't really the purpose of the deal. This offering was to purchase a tenant in common interest in 2 olive grove orchards in Northern California. So there were 2 orchards, and the only thing that was valuable about them were the olive trees. And this group came together along with the operating company who will operate the olive groves, take care of the trees, do the harvesting, do the processing, but they needed some money to just simply acquire these ranches. So our group became a half owner, and the operating company became a half owner. So as they went down the road, they made investment decisions together. Our group didn't invest in the operating company. Our group invested in the land and owned half of the land, and the operating company basically owned half of the land. They owned the land together, but tenants in common. And so what did my group do? My group had to raise $3.5 million. And they set up their minimum investment amount to be $50,000 per investor, $5,000 units. So you could invest $5,000 or more. Over the 50, you could invest 65 or 85 or 100, whatever you wanted, as long as it was in $5,000 increments. And the structure of this offering is pretty standard. It was an 8% preferred return. So on the $3.5 million each year of the cash that they had to distribute, the first 8% of $3.5 million would go to the investors. And then after that, the profits would be split 80-20, 80% to the investors, 20% to the sponsor, until the investors had made a 12% yield. And after the investors had received all of their money back and a 12% yield during the life of the investment, future profits would be split 70-30. And once, of course, when you get all your money back, the preferred return goes away, because the preferred return is calculated on the amount of money you have invested in the deal. So once through operations, the investors were able to be paid back their $3.5 million. The preferred return goes away, and the profit split was 70-30 between the investors and the sponsor. My client took a $55,000 acquisition fee, a 1% asset management fee based on the asset value of the 50% ownership in the olive grove orchards. And they took a 5% fee based on development costs if they had them, a 1% financing fee to pay them for their signature on the loan, And, the signature on the loan has value. So they needed to be compensated for that. And so they took a 1% fee based on the amount of the loan. And then they set it up for a 1% disposition fee. If and when this group sold their 50% ownership in the olive orchards, based on whatever the sale price is, they would get 1%. They would get a 1% disposition fee. Now, this was a 506C offering. In a 506C offering, this client could advertise and get investors that they didn't know. And they thought that was important because in Northern California, the olive industry is very, very popular. But they didn't really know any investors in the olive industry, so they wanted to do social media advertising to tell the community that they were going to join with this operator and buy some orchards and go to work. And so they could advertise. One of the tricks about advertising in the securities law is every investor then needs to be accredited. So they set up their platform to have every investor who came in go and get a third-party accreditation report before they could take them. And that's just simply the rule. The sponsor has to be reasonably assured that every investor obtained through advertising is accredited. And they were able to do this. This was their first venture into a 506C offering. And I've done some other deals with them since. They haven't gone back to 506C because they have a lot of existing investors who invest in some of their other things. But this olive orchard was just a little out of the ordinary. This sponsor has done agricultural work. The sponsor has done some things in the cannabis industry and has investors that are experienced in agricultural projects. So there's a success story, someone that came to us and we helped them with the offering documents and get the deal structured so it could be sold and they could raise the $3.5 million from their investors. So once again, I'm Gene Trowbridge, the Trowbridge Nieh Law Group. If you want to talk about how I can help you, how our firm can help you in structuring an offering so you can raise money to do a business opportunity or buy some real estate, give us a call. Our direct line is 949-570-1507. And our website, if you're interested in what we do, is TNLLP, as in Trowbridge Nieh, LLP.com. Thanks for listening.